What will happen when rates go up? We are expecting that interest rates across the entire country are going to increase as early as either March or April 2022. So what does that mean for you? Well, at this point, nothing. Well, that's not entirely true, and I'm going to explain right after I ask you to please subscribe to the channel. Make sure you hit the notification bell so you don't miss a single update on Surrey, BC, or Canadian real estate. You can book a call with me right down below in the description with just a few simple clicks, and please make sure to hit the like button. That is the best way you can help me grow this channel and get this information out to more people who are wondering what the hell is going to happen when interest rates increase next year. Okay, so the question is, what happens when interest rates go up, which they're likely going to do in the beginning or second half of 2022? The answer to that question is probably nothing. The reason for this is any quarter point rate increase will have no effect on your actual qualification of your mortgage. Your qualification will not change. You see, right now we have something in place in Canada called the mortgage stress test. This means that your income is tested against either a rate of 5.25% or the actual rate you're going to get from the bank plus 2%, whichever is higher. For example, if you are going to your mortgage institution right now and getting a rate hold for 5 years at, let's call it 2.5%, well, you actually have to qualify for your mortgage at 5.25% because 2.5% plus 2 is only 4.5%. Are you following? So if in fact your interest rate is increased a quarter point to, let's call it 2.75%, plus 2 only puts you at 4.75%, meaning your actual qualification doesn't change at all. You still have to qualify at 5.25%. Your actual mortgage payment will increase, but your qualification or the amount that the bank will let you buy doesn't change at all. And this is true in this example, even if there are 2 more rate increases in the new year, because only if your actual interest rate that you were getting from the bank was in excess of 3.25% would you now qualify at that rate as opposed to the predetermined stress test rate. Are you following? Am I making sense? This means that any slowdown that comes into place across the Canadian market as a result of the first either 2 or 3 interest rate increases of a quarter point each will actually be self-imposed by the buyer. Self-imposed because, again, the payment is increasing, but your actual home qualification doesn't change in the least. It's only if the 5-year rate offered to you by your bank exceeds 3.25% that you will start qualifying for a smaller mortgage. And that might happen. One economist at Scotiabank is predicting 8 rate hike increases over the next 2 years, meaning that you could possibly see the qualification rate imposed by the federal government as high as 6.5%.
Well, then what?
Well, believe it or not, a 1% mortgage rate increase will likely push the market down as much as 10%. So being in my marketplace of Surrey, BC, where the average home price is $1.5 million, if we see 4 increases in the next calendar year, rather than the projected 3, well, then we could very well see that bubble finally burst. And that drop would send us back into the Stone Age of just actually May of this year. So in the event that we do see any sort of a catastrophic change in the market, we're probably only going to reset prices to the tune of about 6 months to a year. But this is exactly what we expect with every massive increase in the market. Once the market finds its new level, we should expect a 5 to 10% decrease off of the peak, and the market then finds its new normal. What is up in the air is, will the stress test save us from that first 10% drop if we see 4 rate increases? There is a possibility that only if rates get up to 4.5% will we actually see another 10% dip. So the question mark here is, would we then see a 10% dip or a 20? Well, my very unbiased answer to that, he's gonna say he's unbiased again, is that we actually have no idea. Canada and anywhere else in the world, as far as I know, has never gone through a stress test with increasing interest rates. So will the stress test save us? It could, or we could self-impose the prices coming back down by 2023. But I'm going to go on the record, and you can come back in 2 or 3 years on this video if I'm wrong, that I'm going to see, yes, indeed, the stress test will likely cushion us from any sort of a massive 20% fallback that would blast us back into prices only halfway through the pandemic. And believe it or not, I think the stress test is actually the best regulation that any level of government has brought in to try and cool off the market. I'm very interested to see you comment down below and what you think the impact of inevitably increasing interest rates will have on you and your household. Are you in favor of them, or would you like rates to stay low? Please make sure to let me know down in the comments. Make sure you hit the like button before you go. Check out a playlist while you're here on the channel, and we'll see you in a couple of days.